Guide to bond pricing and related concepts. Understanding bonds, pricing, and key concepts. Agenda: bond pricing fundamentals, present value of a bond and discounting, payoffs to debt holders, accrued interests and clean versus dirty prices, coupon payment dates, spreads and benchmarks, examples of spreads, modern reference rates, SONIA and SOFR. Introduction to bond pricing. Understanding cash flows. Bond pricing requires an understanding of the cash flows associated with a bond, including periodic coupon payments and the final face value. Present value concept. The present value of future payments is crucial for determining the fair value of a bond, allowing investors to compare bonds effectively. Coupon payments. Coupon payments are regular interest payments made to bondholders, which significantly affect the bond's pricing and investment attractiveness. Components that affect bond prices. Interest rates. Interest rates are a primary factor affecting bond prices. When rates rise, bond prices typically fall and vice versa. Credit quality. The credit quality of a bond issuer influences investor confidence. Higher credit quality usually results in higher bond prices. Time to maturity. Bonds with longer maturities are generally more sensitive to interest rates changes, impacting their prices significantly. Market demand. Market demand plays a critical role in bond pricing. Increased demand can push prices higher, whereas decreased demand can lower them. Market factors influencing bond prices. Economic indicators. Economic indicators such as GDP growth and employment rates provide insights into market conditions that affect bond prices. Inflation rates. Inflation rates directly influence purchasing power and interest rates, which in turn impact bond prices and yields. Central bank policies. Central bank policies, including interest rate adjustments, play a crucial role in shaping the bond market dynamics. Calculating the present value of a bond. Future cash flows. The future cash flows of a bond consist of periodic coupon payments and the repayment of its face value at maturity. Discounting cash flows. Discounting future cash flows allows investors to determine the present value of a bond, reflecting its current worth. Estimating worth. Calculating present value helps investors estimate the bond's worth and make informed investment decisions based on expected returns. Understanding discounting methods. Discounting methods overview. Various discounting methods exist, with yield to maturity and spot rate being the most commonly used. Yield to maturity method. The yield to maturity approach helps in determining the total return anticipated on a bond, if held until maturity. Spot rate approach. The spot rate approach calculates the present value of future cash flows using current interest rates for different maturities. Time value of money in bond pricing. Principle of time value. The time value of money principle asserts that money available today is worth more than the same amount in the future due to its potential earning capacity. Importance in bond pricing. This principle is essential in bond pricing as it helps investors discount future cash flows to determine the present value of bonds. Opportunity cost of capital. The time value of money reflects the opportunity cost of capital, as funds could be invested elsewhere for potential returns. Expected payoffs and yield. Understanding expected payoffs. Expected payoffs are the anticipated cash flows generated from holding a bond through its life cycle. Yield explained. Yield represents the return on investment for a bond, helping investors assess profitability and risk. Evaluating bond attractiveness. Both expected payoffs and yield are essential for determining the overall attractiveness of a bond investment. Factors affecting payoffs. Interest rates. Interest rates play a significant role in determining payoff amounts, affecting the cost of borrowing and investment returns. Issuer credit rating. Credit rating of the issuer is crucial as it influences the perceived risks and potential returns from an investment. Market conditions, including economic trends and investor sentiment, can greatly impact payoff amounts and investment strategies. Credit risk and default probability. Understanding credit risk. Credit risk highlights the potential for a bond issuer to fail in making payments to bondholders. Default probabilities. Assessing default probabilities allows investors to gauge the risk linked to bond investments effectively. Bond investment risks. Investors must understand the risks of bond investments, as defaults can lead to significant financial losses. Definition of accrued interest. What is accrued interest? Accrued interest is the interest that builds up on a bond between its coupon payment dates. Importance for bond purchase. Accrued interest is crucial for calculating the total cost of a bond when buying it. Difference between clean and dirty prices. Clean price definition. The clean price of a bond is the price excluding any accrued interest. It reflects the bond's value without additional costs. Dirty price definition. Dirty price includes accrued interest, representing the total amount a buyer pays for the bond at a specific time. Importance in trading. Understanding the difference between clean and dirty prices is essential for accurate bond pricing and trading strategies. Importance in bond transactions. Accrued interest. Accrued interest is essential for determining the value of a bond at the time of transaction, impacting buyers and sellers. Clean versus dirty prices. The distinction between clean and dirty prices affects how bonds are quoted and traded, influencing market dynamics. Trading impact. Understanding these pricing distinctions is crucial for investors to make informed decisions in bond trading. Significance of coupon payment dates. Understanding coupon payments. Coupon payment dates are essential for bondholders as they mark when interest payments are received. Cash flow management. These dates are crucial for managing cash flow, especially for investors relying on regular income. Evaluating bond investments. Bond payment dates help investors evaluate the timing and reliability of returns from bond investments. Frequency of coupon payments. Coupon payment frequencies. Bonds can offer different coupon payment frequencies, annually, semi-annually, or quarterly, affecting investor returns. Impact on yield. The frequency of coupon payments can significantly influence the bond's overall yield and pricing in the market. Impact on bond pricing. Coupon payment timing. The timing of coupon payments is crucial as it directly influences the present value of a bond, affecting its market price. Frequency of payments. Bonds with more frequent coupon payments often have higher prices due to increased cash flow certainty for investors. Investor demand. Investor demand can vary with coupon payment characteristics, influencing the overall pricing strategies in bond markets. Understanding spreads in bond pricing. Definition of spreads. Spreads represents the difference in yield between two bonds or bond-related instruments, indicating their relative value. Risk assessment. Analyzing spreads helps investors assess the risk associated with different bonds, guiding their investment decisions. Return characteristics. Spreads provide insights into the expected return on investment, reflecting market perceptions and trends. Role of benchmarks in bond valuation. Evaluating bond prices. Benchmarks serve as essential reference points for evaluating current bond prices in the market. Determining spreads. Spreads are determined by comparing bond yields to benchmark rates, like Treasury rates, providing insights into investment risks. Assessing market conditions. Benchmarks are critical for assessing overall market conditions and trends in bond valuation. Examples of benchmark rates. Government securities. Government securities are debt instruments issued by a government to support government spending and are often used as benchmark rates. LIBOR rates. The London Interbank Offered Rate LIBOR is a benchmark rate that indicates borrowing costs among banks and is widely used in financial markets. Reference rates. Reference rates serve as standards for pricing various financial products, ensuring transparency and consistency in bond pricing and analysis. Spread to government securities. Understanding risk premium. The spread represents the additional return investors require for taking on risk compared to government securities. Investor value assessment. Investors use the spread to evaluate the relative value of different bonds and make informed investment choices. Spread to published reference rates. Bond yield analysis. Analyzing a bond's yield against a benchmark provides insights into its market competitiveness. Industry benchmark importance. Industry benchmarks serve as crucial reference points for investors assessing bond performance. Spread to swap rates. Bond yields overview. Bond yields represent the returns investors can expect from holding bonds, depending on market conditions. Understanding swap rates. Swap rates are key indicators in the interest rate swap market, reflecting the cost of exchanging fixed and floating rate payments. Liquidity and risk profiles. Analyzing liquidity differences between bonds and swaps helps investors assess their risk exposure and make better investment choices. Modern reference rates, SONIA and SOFR. What is SONIA? SONIA is a benchmark interest rate that indicates the average rates for overnight unsecured transactions in the British pound. Purpose of SONIA. SONIA serves as a crucial reference point for financial instruments that helps in understanding overnight borrowing costs. SONIA and banks. The rate reflects the average cost for banks to borrow funds overnight, impacting lending and investment decisions. Introduction to SOFR. What is SOFR? SOFR stands for Secured Overnight Financing Rate and serves as a key benchmark for interest rates on loans and derivatives. Repo market transactions. SOFR is calculated based on actual transactions in the repo market, reflecting the cost of borrowing cash overnight. Importance of SOFR. As a benchmark, SOFR is crucial for financial institutions and impacts various financial products including loans and derivatives. Comparison and applications. Importance of SONIA. SONIA, or the Sterling Overnight Index Average, is a key benchmark for sterling-denominated financial instruments, influencing bond pricing significantly. Role of SOFR. SOFR, or the Secured Overnight Financing Rate, serves as a crucial benchmark for US dollar-denominated debt instruments, affecting pricing and risk assessments. Applications in finance. Both SONIA and SOFR are vital for modern debt instruments, ensuring transparency and efficiency in financial markets. Conclusion. Importance of bond pricing. Understanding bond pricing is crucial for making informed investment decisions and optimizing portfolio performance. Influence on investment strategies. Bond pricing fundamentals significantly impact various investment strategies, guiding investors in their market decisions. Market dynamics. Modern benchmarks and bond pricing play a vital role in shaping market dynamics and investor behavior. Thank you.